Good morning from Washington, D.C., and good morning, good afternoon, or good evening to all our guests on our webinar this morning. I am Doug Silliman, the president of the Arab Gulf States Institute, and I'm very happy to welcome all of you to our program this morning, looking to 2026, economic prospects and policy changes in the Gulf Cooperation Council countries. Now, 2025 has been a significant, some might say a tumultuous year for the economies of the Gulf. A lot has happened. Each of the GCC countries has got major vision programs in which they are investing a lot of money to try and transform their societies and their economies. In addition to that, several GCC countries in the past year have pledged literally trillions of dollars of spending and investment in artificial intelligence, technology, defense equipment, in addition to what they're spending domestically. And pretty much across the board, there has been a deepening of global outreach of GCC countries on the economic front, well beyond hydrocarbons, the traditional area that we're used to seeing Gulf countries interact with the world. So what should we expect in 2026? Well, we've got an excellent panel this morning, this afternoon, this evening to give you some ideas of what to look for. First, on my right is Amine, who is the Assistant Director and Mission Chief for Saudi Arabia and the head of the GCC division at the International Monetary Fund. He's a regular visitor here at AGSI, and we are very happy for the collaboration with the IMF. Not only has Amine worked for several years on this portfolio, but he's worked on Indonesia, Lebanon, Mauritania, Turkey, Tunisia, Nigeria, Uganda, and others, none of which are particularly easy to do from a financial economic standpoint. Joining us from the UAE is Malik, the chief economist from Abu Dhabi Commercial Bank. Monica, welcome. We're happy to have you with us. Before joining Abu Dhabi Commercial Bank, she's worked for EFG Hermes, Standard Chartered Bank in Dubai, and Dun & Bradstreet in London. We're pleased to have you with us. And leading the discussion today is AGSI's visiting fellow, Tim Callen, who, in addition to what he does now for AGSI, used to sit in Amine's seat over at the IMF. So, Tim, I will hand this entirely over to you to run the discussion.
Thank you very much, Doug, and let me just add my welcome to everybody joining us in the room and joining us online, and add my thanks to both Amine and Monica for agreeing to join the panel today. How we're going to run things, Amine is going to give us a quick overview of the main findings of the recent IMF report on the GCC region. And then Monica is going to offer her thoughts coming from the region, sitting in the region of what's going on, both responding to what's in the IMF report, but also adding her particular colour from Abu Dhabi on the regional development. As said, if we could encourage everybody who's joining us online to submit their questions through the Q&A function online as soon as possible. We'll try and get to as many questions both from within the room and online as we can. So with that, I'm going to waste no further time. I'm going to hand over to Amine, who's going to run us through a quick overview presentation of the report.
Yeah. Thank you very much, Tim, for having me. Thank you, Ambassador, for the welcome and also having me. It's always a pleasure to be back at the Arab Gulf States Institute, and good to have Monica join us in the discussion. So let me just give a brief overview of the report and just some salient fact. There's a lot of annexes and detailed background in the note. I encourage you to read that. On the recent development, I mean, one story is that the GCC has continued to show strong economic resilience. It's on the oil hydrocarbon front, clearly the fact that you had OPEC plus cuts, you had both the first tranche of the OPEC plus, the second tranche of the OPEC plus, the 1.65 million barrels a day, the third tranche, which was the 2.2 million barrels a day. And GCC countries represent a large part of these voluntary aid countries of OPEC plus that participated in that. And that affected the performance on hydrocarbon. But the good news is that non-hydrocarbons still remain robust. 3.5, 3.7% on average. Some differences across countries, some of that driven by some idiosyncratic projects of vision implementation. But resilience is there, notwithstanding the amount of shocks that the world economy has seen, whether it's tariffs, uncertainty, etc. All of that did not seem to impact the domestic demand. Inflation has remained quite contained, supported by the pegs, and tight monetary policy. Monetary policy did remain tight, even though there was some loosening, but if you compare it with a neutral rate, there has been tighter monetary policy on average. Now, we are starting to see some narrowing of the current account balances. Saudi Arabia has moved into a deficit. Others, the current account deficit, the current account surplus is narrowing. And that's mostly related to some of the investment-related imports. In some countries, remittances are also up. But one story to remember here is that the buffers remain quite comfortable. Whether we look at reserve adequacy in terms of import cover or in terms of the IMF metric, which looks at also other factors in terms of liquidity. Now, the resilience here that I talked about, I want to emphasize what happened with tariffs. And here with tariffs, exports of the GCC to the US have been actually quite limited. If you look at across the countries, you have Kuwait close to zero. And if you were to look at the highest in terms of total exports, you would have Bahrain would be at 8%. In terms of percent of GDP, the numbers are even lower. It's like 2.5% of GDP is the highest for the UAE. So there's still limited exposure. We're also not seeing it in terms of the tariffs that are still remaining quite low. And therefore, we didn't really see that as a channel or as a big impact for the countries in the region. Of note, though, the tariffs on aluminium and steel, which would have impacted, would have a small impact on Bahrain and the UAE. Now, among these, we have countries that have still kept quite, I would say, conservative fiscal policy, although you've seen, if you look at some of the overall fiscal balance, you would have seen for some country like Saudi Arabia deterioration. But if you think about it in terms of what we call the fiscal impulse, in terms of non-oil primary balance over non-oil GDP, in most of the countries, for all the countries, there's actually quite an improvement, which means that there's a fiscal effort that have been made. And I'll come back to this story later on. And amidst that, the gross government debt remains quite low and quite moderate. I know we have heard stories of Kuwait going to the market, Saudi Arabia being one of the largest AT1 issuers, and etc. But if you were to still look at it in terms of the stock of debt, it's still quite manageable. Of course, Bahrain is on a different path. But if you look at all of the other countries, it's still comfortably below 40%, and this is without even looking at the concept of net debt. And with the exception of Bahrain, all of the countries are investment grade. And if you were to listen to me doing this presentation 2 weeks ago, I would have said Oman has 2 out of 3 credit rating agencies making it investment grade. As of last week, all credit agencies have upgraded Oman to investment grade status, and this is reflecting the reforms that they had done and also the strong performance on the fiscal over the past few years. So where do we see the situation going forward? Clearly, we now have oil or hydrocarbon production that will now be accelerating from 2025-26. Why? Because OPEC Plus has decided to unwind it completely, at least until the end of December. After that, there's a pause for 3 months that's allowed, but we expect some favorable impact of production. For example, Saudi Arabia used to produce only a year ago 9 million barrels a day. Today it's at 10.1. So all of that is favorable for the economy. That will help offset some of the weaker oil price dynamics that may be coming. And at the same time, we do expect non-hydrocarbon growth to remain robust. And non-hydrocarbon growth remaining robust, meaning around 3.7, above some countries at about 4.5%. Others, we have some idiosyncratic projects, so countries like Saudi Arabia, the World Cup, Expo, Asia Games. Some of these investments are likely to continue. I know there's been talk recently about recalibration because of lower oil price, but we still expect some of those needed investments to continue and to keep driving domestic demand. And we're seeing that in most of the countries in the region. I mean, non-hydrocarbon rate that vary between 2.5 and 4.5, but most of them are above 3.5 and at least positive for the region, including because of some implementation of vision of reform implementation. Headline inflation still to remain contained. We don't expect pressure on that, and I think with some energy prices going down, probably more favorable. And the current account balance is expected to further narrow going forward. Again, with the story that external buffers, we still expect them to diminish, but still remain quite strong or quite comfortable for all of the countries. And you've seen here that in our projection, with the exception of Saudi Arabia, we do expect most of the countries to maintain quite sizable current account surplus, and Oman being on a deficit temporarily before going back up. Again, the demand-driven body, the consumption, but also the fact that we have investment that will be driving some of these imports will be impacting the current account. And some of these investments, we do expect non-oil investment, for example, to be lower than in the past. So it's not the 13, 15% growth, but it's a growth of 5, 6, 7% that is still quite reasonable. Now, on the risks, there are quite a few risks. We have the upside and the downside. I'm going to focus on the downside, not just because it's not because the IMF likes the downsides, because I think the story is there, but obviously we can also have the upside story is still likely to materialize. But in the near term, I would say that the risks are more tilted to the downside. One is lower oil price. There is a supply glut that a lot of people are expecting in the next year that may not have been, that may not fully be in the baseline. We have in our baseline oil prices at $65, $66. People expecting a supply glut will see prices closer to the mid-50s. Some see it even lower, and it is, assuming no further response from OPEC plus. And you get here, you have demand that's weaker, that's been driven also up by some strategic stockpiling by China. You have, the supply that's really coming up strong, not just from OPEC plus, but non-OPEC plus is still continuing big production increases, including in Guyana, Canada, and the US. And therefore, this is all adding to the supply in the market. And the question here is whether there will be lower oil prices. So far, OPEC plus has been able to increase supply without prices falling below, I would say, the $63 to $70 range. But market expectations may indicate otherwise. So we think this is one of the big downside risks. If you look in detail at our GCC surveillance note, one of the annexes there has a downside scenario. What happens if oil prices are at $40? So clearly, you're going to have non-oil growth that's going to be impacted 1.7 to 2 percentage point lower. You're going to have a deficit, both current account and fiscal, higher, about 6 to 8% of GDP. But I think what's important is that there's quite a lot of buffers and policy space for these countries to at least accommodate the shock without resorting to big spending restraint and trying to worsen growth even more. Let me make sure I'm okay on time. So the other shock, obviously, on the medium term, you're going to have it's more like a two-sided risk here. Geoeconomic fragmentation could also impact growth again through the oil price channel, the energy transition. But the main risk that we see is really on the near term happening, and including if you have tighter global conditions. Policy priorities. So here we have 4 different policy priorities. I'm going to go into more detail on fiscal and structural, so I'm not going to elaborate more on that here. But on monetary policy, we still believe that the currency pegs remain appropriate and have served the GCC well. They should be maintained. Obviously, I think there's still work that can be done to enhance the monetary transmission mechanism, including by deepening the financial markets. And here we can see that if you look at a lot of the countries on deepening the financial market, some of the countries don't have a yield curve that really goes at all instruments. So there's more efficiency that can be gained there, but also in trying to reduce sometimes the funding pressure. A lot of the GCC countries are bank-centric, and there's not enough resource to local debt markets, and I'll come to that on the structural issues. But that is affecting the financial sector because right now, in some of the countries, Saudi, for example, you have credit growth that's still in double digit. The lending to deposit ratio is around 110, 114%. So there's still quite a pressure there on the banks. And if there were ways to provide other funding that would help reduce pressure, the authorities, and I think they're all doing it, looking at proactively managing macroprudential policies. A lot of them have introduced a countercyclical capital buffer, which will become effective in 2026. Particularly if you look at Saudi and UAE, where you have double-digit credit growth, one in real estate, the other one really across the board as firms want to participate. And the idea there is to really harmonize across the GCC. A lot of them have different set of rules, but also to try to make sure that the risks are avoided. I mean, look, if you look at the financial system in the region, regulations are quite strong and it's quite prudent. I mean, this is a strong footing. If you look at capital adequacy ratios, if you look at the NPLs, at liquidity, these are all well above Basel requirements. But the idea here is to try to preempt future risk going forward. Now, on fiscal policy, as I said, remember at the beginning, I talked about the fiscal impulse as a non-oil primary over non-oil fiscal or non-oil GDP. And there we clearly are seeing some improvement happening. We still see a mildly contractionary fiscal stance. Is it enough? Not. And I'll come to that in a bit about why we don't think it's enough. But for the near term, it means that they are still able to accommodate some of the shocks. And remember in the past, when you had oil prices that are lower, and remember in 2024, oil prices are lower. They're like even though it was $80 a barrel, they're like much lower than in 23 or 22. And we've been seeing clearly that fiscal policy has become less and less pro-cyclical. Which means what? Which means that the authorities have not cut spending in line with oil price the way they used to do it, or that they are spending with higher oil price the way they used to do it. That's good news. Now, we also have to take into account here that this is looking only at central government. We also know that sovereign wealth funds and GREs are also playing a role that may be countercyclical, and that has been also helping the economies. But I see this as one of the positive, and that's why we've been saying that, in the near term, maybe there's no need to try to make the downturn or make the or worsen the impact on growth of a lower oil price. Now, over the medium term, there's still quite a lot of adjustment. We still are thinking that there's a lot that can be done for intergenerational equity, and except the UAE, all of the countries need to adjust over the medium term, some of them by a lot. You will tell me, wow, is that really possible? In a lot of these countries, there's a lot of potential just on the revenue side. There's a potential also on constraining for the wage bill, which in some countries is like 45% of total spending. But just on the revenue, Oman has introduced personal income tax, but none of the others. You have quite a lot of room on corporate income tax. VAT, some are at 5%, others at 15%. There's quite a lot even on harmonizing the tax rates across the GCC and increasing the revenue potential. Now, structural reforms, we've seen some progress on diversification. Clearly, if you look at the countries from 2010 to today, oil represents a smaller part of output. In terms of trade, oil represents also a larger part, but it's still quite a lot to do to reach the EM average, the advanced economy average. And we can see that some countries were already diversified before and now need to do more, but others, the progress has not maybe been as much as one would want. But it's not for lack of trying. If you look at the business environment, there's been a huge pickup in terms of reforms. If you look at the structural reforms that have happened, Saudi, this year, the foreign investment code, you have the commercial transactions law that had happened, and the civil code. All of those are there. The coming soon, the ease of entry for foreigners into the real estate and property market. All of those are there to facilitate the business environment and try to increase non-oil growth. Of course, on technology is also quite important, increasing productivity. And some of these countries, I know you've all heard the large investments that are happening here in terms of data centers and etc. So this is, the AI will be one area where a lot of the countries, the sovereign wealth funds seem to be putting a lot more emphasis. Are the GCC countries well placed? We believe they are. We have this AI preparedness index, where clearly you say, and AI preparedness index looks at 4 dimensions. Look at the regulation, innovation, infrastructure, and the talent or human capital. And in all those dimensions, the GCC countries are in line, I would say, with emerging markets, still below the level of advanced economies, but because they're quite advanced on digital infrastructure and others, they can already, this could be an area of growth that would benefit the economy. And I've been too long, so let me just finish here with the last slide. So the structural reforms, we believe, is what has helped some of those countries diversify. We believe that that should continue irrespective to what is happening on oil prices. And then as a block, you heard me talk earlier about financial markets. Deeper financial markets will lead to higher growth. Why? Because it will increase access to funding. And we looked at this with respect to potential of where some of those countries could be with respect to potential market size. And you see the gaps in percent of GDP are pretty large, from 15% to 20% of GDP. There's still quite a lot that can be done to develop the infrastructure of the bond market, create a market for secondary and all of that. And at the same time, I think GCC will be stronger as a block, whether you have a capital market union or, if you were to look at intra-trade in GCC is only 10% of total trade. In the EU, that's 50% of total trade. And here, just if you look at the import tariffs in the region are actually not that high. You have some NTBs and etc. So as the GCC could help, lowering some of the tariffs some of the other regions have on the GCC, but the GCC itself doesn't have a lot of high tariffs, and therefore that is a positive factor to facilitate trade. But then also to facilitate trade, what would be helpful is that the GCC operates as a bloc. There's a lot of these comprehensive trade agreements that are being signed individually. What's important is that if they are signed as a GCC, you will have some economies of scale, and we believe will help promote growth. And with this, I'll stop, and you'll find a lot more details in our report. Thank you very much.
Thank you, Amine. Got that, and hand over to Monica. Welcome, Monica. The floor is yours.
Thank you very much, Tim and Amine, and it's a pleasure to be here. Thank you for the fantastic presentation, Amine. I think in many ways our views are very much in line with the IMF's. We've seen this year GCC economies continuing to perform very strongly, of course benefiting from the higher oil and gas output for headline GDP growth, but the non-oil economy has also continued to perform well, really reflecting the investment programs and the focus on diversifying their economies. Now, again, focusing particularly on the non-oil economy, because we believe that best reflects economic activity on the ground. We think that going forward, while we expect GCC non-oil activity to remain strong and above global growth, which we see as global growth impacted by many challenges, greater fragmentation. We do think the Gulf will stand out, but we think there'll be more differentiation amongst the GCC countries. And that really reflects the fact that oil prices, of course, have come down over the last 2 years. The fiscal positions are different, and we think that the governments with the stronger fiscal positions are going to perform more strongly. Starting off with Saudi Arabia, of course, a key support factor is low government debt levels. We think even with the widening fiscal deficit this year and next year, government debt in GDP terms will remain below 35% of GDP. However, of course, the government spending did see a limited pullback this year, and again, a limited pullback is forecast for next year. Though I think fiscal space, if you do see oil prices fall below $60 a barrel, we're at that now for Brent crude. Again, yes, there's space for government spending to remain high for 2 or 3 more years, but I think if it goes beyond that, you would need to see deeper fiscal retrenchment. Again, we do see space for government spending to remain high. The retrenchment has been very limited so far, but it's more the speed at which government debt builds up. We have seen some impact on GDP growth, with the government pulling back some degree of spending and on the investment front. On year terms, you saw gross fixed capital formation contracting in the second quarter of the year and the third quarter of the year. A part of that, of course, could be related to the fact that we're in that in-between period between the recalibration of projects and the new project cycle really building up. And I think as we go into 2026, that's going to be very critical. At the FII that was held at end of October, there were some indications of the new areas of focus. Of course, the projects that are linked to the hosting of events, whether it's the World Cup, whether it's the Expo, we expect this to be a key area of government spending and PIF spending, and that's still going to be significant and large, but also a focus on sectors that are going to provide more returns. And I think this is a very prudent approach, moving away from large projects and giga projects where the revenue generation outlook was uncertain, to more projects that you can have returns. So I think this is a very positive shift. There have been costs related to this, but better now when government and PIF debt is low. So I think we do expect Saudi non-oil GDP growth to remain solid, but decelerating from the levels that we've seen from the last few years, a more cautious approach, a more targeted approach. But I think this is far more prudent given the fact that oil prices are lower. We see budget break-even oil prices in Brent crude terms at around $90 a barrel, above $90 a barrel. So, again, while there is fiscal space with low government debt levels, we think that this more targeted approach is very prudent. For the UAE, we continue to see fiscal surpluses despite expansionary government spending outlooks. And really, we think that the UAE is in that sweet spot where the fiscal reforms have benefited the fiscal position, whether it's the recent increase in taxes for large international corporations to 15%, earlier reforms as well. We think that the UAE is in a point where you still have fiscal surpluses, expansionary government spending, ongoing progress with broad diversification programs led by GREs. GREs performing very strongly, but also benefits of private sector growth, population growth. So very broad base, sort of growth drivers. Again, we see a budget break even for the UAE consolidated at closer to $55 a barrel. So more fiscal headroom here. On the private side, you're seeing more corporates moving here, more people moving here. We're seeing a transfer of wealth and knowledge. And that's also very visible in the banking sector with strong private sector deposits coming here as well. Amine had mentioned the CEPA agreements. There's 14 signed, more in progress. And we think it's not only strengthening the trade integration, UAE's role as a transshipment hub and trade hub, strengthening this position at a time of rising global fragmentation, but also supporting FDI into the UAE. So in 2024, FDI inflows to UAE saw over 40% increase year on year, but was over 8% of total GDP. So that really reflects the momentum that we're seeing there as well. For Qatar, again, very strong position. We see the fiscal position returning to a surplus next year. Very strong headline GDP growth over the next few years as the gas production ramps up. But we are seeing on the non-oil side, yes, there's growth, there's strong performance in areas like tourism. The government is looking at new ways to expand tourism and output there. Areas linked to transportation doing well. But here we've seen, after the World Cup, a lot more of the non-oil investment cycle already completed. So you don't have that benefit of both the strong balance sheet and the non-oil growth perspective. Kuwait remains interesting because now we're seeing sort of the pickup in reform program. I think again we've started to see the government return to the debt market, lowest debt amongst the GCC. But here I think while there's been some important reforms, the debt funding program, we expect to see the housing reform package coming in, which would support mortgage demand and support credit growth. I think again, signs of stronger investment momentum will be needed and positive on that front. Amine had mentioned Oman and how it's investment grade. I think this, it's the fact that these upgrades have happened as oil prices have come down, the fact that we do expect to see a small deficit this year, but very much contained. I think where Oman really stands out is the fact that you are seeing ongoing investment, but they're also attracting a lot of FDI. And I think that's going to really be critical for Saudi Arabia going forward to really bring in FDI to support the investment program, private capital, and perhaps this shift to more of a returns-based investment will be supportive of that. And, Oman has had that very targeted focus. We have, recently seen some cancellation of projects on the green hydrogen side because of higher costs. But nevertheless, we're seeing investment in areas such as renewables, in tourism projects, in transport logistics. So I think this is an area that stands out. And finally, for Bahrain, I don't want to take too much of the time. It's really a case of the fiscal reforms. They've lagged behind what has been announced. We expect, of course, government debt above 130% of GDP, a lot of spending still on wages and on the social front. There's no new announcements of GCC support packages, but I think it's really that critical point of the fiscal reforms and the fiscal adjustment in the case of Bahrain. So, not wanting to take too long, I'll hand over back to Tim and Amine.
Very good. Thank you very much, Monica. Maybe I can kick off with a question maybe to both of you. So I think you've both alluded to sort of different short and medium term prospects across countries. If I look at the IMF report, I think, in the medium term, you have Kuwait at growth of 2.5%, UAE of growth of 4.5%. Could you maybe both elaborate a little bit more on what you see as determining factors in those growth differences medium term? Clearly there are different things going on short term, but why over a 5-year period is the expectation of quite a substantial growth difference across the region? Maybe Amine to start, and then I'll go.
I think we have to look at in terms of potential for the market to grow and what we see. I mean, Saudi Arabia, UAE are some of the largest economies here in the GCC. We still expect not only a shift towards investment, to domestic demand to be driven by investment over the near term, but then consumption to start also playing a role. And as the economy diversifies a bit, we've seen some of that already, and we expect some of those projects to carry that. So, the country's specific factors for Saudi, for example, includes Expo, which is 2030, World Cup 2034, Asia Games before that. So that takes quite a lot already into a project. So, there could be actually a positive surprise based on that. UAE, so the investment is there. I mean, on Qatar, you have it's more expansion on hydrocarbon because of the gas. But then again, some of the tourism is expected to continue our industry. And Kuwait, it's based also on a lot of these countries have a lot of these reform plans that they're trying. So assuming that some of the structural reforms do happen and you get a positive impulse on that. And then it's based also on current announcements. So for Kuwait, based on the plans that we have, what we see in terms of investment driven or consumption, we do expect growth to be a bit lower than the others.
Monica, anything to add in a cross-country perspective?
Yes, absolutely. I think, again, I think on the UAE, a lot of the non-oil sectors are, irrespective of the direct near-term impact of the investment program. Of course, in the longer term, the more you invest, the more the capacity increases. That's going to support structural growth. But the fact that the global economy has been more resilient and has performed more resilient means that a lot of the sectors that the GREs are in are performing strongly, and that's supporting the medium-term investment program. I think also in the case of the UAE, what's also very important is on the oil side and the hydrocarbon side, we've got the baseline adjustment also from OPEC plus. So you're seeing more of an increase on those fronts as well. I think, again, Oman and the UAE stand out again for the degree of FDI that's coming in. So I think that's also an important differentiator. I do agree that a lot of these projects in Saudi, the hosting events, those are going to be very important drivers of non-oil GDP growth, of investment. We've seen in Qatar after holding the World Cup that you've seen since then the tourism numbers have continued to rise as it's been more in the focus. And I think, Saudi does have we do expect to see that structural medium term benefit as not only does the infrastructure increase, whether it's through the airports, the airlines, etc., but I also think that it's worth highlighting that, again, given the spending requirements of these projects and the fact that we do see lower oil prices in the next few years, that the projects do have to be managed very carefully, given the costs involved in the medium term. So I think there are differentiators, different cycles, different area of focus. Again, for Oman, it's very much tourism. It's very much clean and renewable energies, the logistics side. So there are marked differences and growth factors. But I think also in the medium term, the challenges will increase, and that's really also what needs to be looked at carefully.
Monica, maybe stay with you and just ask. So, as Amine outlined, there's been quite a increase in borrowing by a number of GCC countries in the last couple of years. Looking forward, how do you see appetite in financial markets for GCC debt? And how would that be affected if oil prices, rather than being in the low 60s, are say in the low to mid 50s?
Absolutely. And I think this is where the strength of the government balance sheet really stands out. And I think, again, appetite for Abu Dhabi and Qatar, that will really, very narrow margins and spreads over Treasury. I think that really stands out. I think, Dubai, we expect the fiscal reforms that we've seen here, the reduction in government and GRE debts, that's going to be, that stands in good stead. We've seen, of course, not only the Saudi government, but the PIF, Saudi Aramco as well, issuing large amounts of debt. And there's been very, very strong demand on these fronts. I think, again, Saudi could look at different regions and different currencies to issue debt in, especially tapping the Asian markets or, the Sukuk market where liquidity is less available. But I think one question or one sentiment that comes out a lot when we speak to investors is that while they're very comfortable with Saudi at the moment, if you continue to have more issuances, fiscal deficits of over 5% of GDP, you could start seeing the risk premium increase for Saudi. So I think, again, that is something that we're very much looking out for. We still think, as things stand currently, that demand will remain strong. This is not an issue maybe for the next 1, 2, 3 years, but more for the medium term. Our view is the fiscal deficit will be larger than indicated by the Saudi budget, which gives medium-term indications. Saudi expects government revenue to pick up after 2027, and that will enable government spending growth. Our forecasts do not assume that revenue will pick up. So again, for the medium term, oil prices and oil revenue will be critical. And also it's the speed and magnitude of the deficits and the pace that government debt increases in the medium term.
Okay, very good, thank you. I have a question online which I'll ask Amine to address. So it's does the forecast you published for non-hydrocarbon growth include the impact of introducing cutting-edge technology such as AI, machine learning, data centers, etc.?
Thank you, Tim. I'll answer this in 30 seconds, but first building up on what Monica said, clearly when you look at what countries are borrowing in the GCC, there's been quite a lot of increase. But what interesting statistics is that the spreads have actually tightened, not widened. And they've been remaining quite low even in this environment. So I think the appetite still seems to be there. And it depends on then to maintain that would be important that the medium-term fiscal policies remain appropriate. On the question, not in our baseline, we do not include productivity gains. It's still quite uncertain. We've done some analysis for Saudi Arabia, for example, where you have labor productivity that could increase by 5% if AI is to be implemented, and depending again on the scenario and the level of adoption by different industries. We have done some analysis at the IMF that says that non-oil growth could increase, or there was some analysis done that shows that for the GCC, non-oil growth could increase by 1.7 to 2% a year. But again, it's still too early at this stage, so we are not. So this would be, I would say, an upside potential to our growth. So at this stage, until we see how the industry is developing, even this AI investment, how is that going to translate into higher growth? Are we going to see it in terms of adoption by different industries? And if we look at AI in different industries in the GCC, it's still not being adopted by a lot. There was, I think, a McKinsey study showing in terms of AI use is still quite low, and this is GCC not the only region for that. And then how are these data centers going to benefit growth, and what is the model that's going to be used here? So this is still something we are grappling with, and then we will refine our forecast once we have a better idea of what will be the impact.
Good, thank you. I have a question in the room, Doug.
In your remarks, you recommended that the GCC work toward economic integration and gave two policy areas, sort of tax policy, sort of income tax and very VAT rates, as well as trade policy, with the UAE's CEPA agreements being kind of bilateral agreements, not multilateral. For Monica, I'll ask the second half of this question. Do you see these are realistic goals, and are there any signs in your conversations with GCC governments that they are contemplating extending or having a more common policy other than the suggested, for example, GCC-wide tourist visas that are currently being negotiated? And Monica, the same question for you. Is this idea of economic integration on tax policy, trade policy, tourism policy, is this something that GCC governments seem to be moving toward, or are they still acting independently of one another?
I mean, look, there's GCC meets quite often, and if you talk to the GCC Secretary General, and if you look at the GCC Ministry, I mean, there's a lot of discussions going on how to strengthen integration. So, of course, you have like a customs union. There's you have negotiated for the GCC. The GCC as a whole have negotiated trade agreements with countries. The problem is that you also have individual GCC countries. So, which one will dominate? I think there's probably going to be more advantages when you negotiate as a group. I think this is happening. I know there are discussions. It's not all easy. There are discussions on trade, on rules of origin. Also, in terms of what is it that we look at? If you do rules of origin and local content, what does that mean with respect to using labor from the GCC? In some of them, you have more expats than not, and so I think these are some of the technicalities they're working on. I think it will be. I don't think we're anywhere near capital market union. But I think clearly the benefits are there, particularly as you start seeing in the world new technologies developing on fintech and others. So, I think there's a lot of work to be done. But I think as the benefits became more known, and as I think as people realize that with economies of scale, you may be getting more than having competition within countries. This tourist visa would be one option, but I think in terms of trading goods or allowing some of the ports or some of the same, just something that may be more straightforward, like harmonization of regulations, right? Harmonization of taxation. All of those would actually help facilitate an investor knowing that he can come to a country X or Y and get the same advantages. So this is still part of the discussion, but it's going to take time.
Monica?
Yes, I think again we're seeing two-speed movements. You're having some trade negotiations that are being done as a bloc, and others, for example, that UAE with the CEPA agreements are moving very quickly, signing them. So I think again it's going to be a multi-speed progress. I do agree that I think it would be very positive if you start having for example, the tourist visas coming in. I think that will really boost tourism, and you can have multi-destination stops. But I think at the moment we'll continue to see this again two-speed progress continuing.
Are there other questions in the room? Yeah, Kristen.
Hi, Kristen Diwan. I'm here at the Institute. I wanted to ask about Bahrain a bit more, because I guess there seems to be a bit more concern in terms of, you're talking a lot about their fiscal balances and these sorts of things in their position. I know that there's need for them to move further. And you mentioned this, Monica, in your comments on their fiscal program. But from your kind of perspective, or my perspective, I guess, more as a political economist, it seems like do you feel like there's much more room for them to go before it really starts biting on the population, where they're really going to start to feel that? Is there a lot of fat to cut, I guess is what I'm wondering, or is it getting kind of lean for them? And then a second question on Bahrain, I'm just kind of wondering, in their diversification, where it's looking right now. I know that, previously they were kind of like a useful backstop for Saudi Arabia. I imagine that sort of lessened as Saudi opens up. And also I know that they were often, the big center for finance, but I've seen a lot of that go a bit more to the UAE. So where do you see kind of the potential for their growth and defining themselves in diversification? Thank you.
Monica, do you want to kick off with that one?
Okay. On the fat and the budget, I think there's still quite a lot of room to move ahead. If we look at the earlier fiscal adjustment program that was provided, I think compared to that, the progress has been relatively slow on the fiscal reforms. So I still think there's space for that, but I think it is very difficult to do these reforms when economic activity is still weaker. And if we look at project awards and investment activity, really before the pandemic, you could see Bahrain still seeing a lot of progress on various different projects, and much of that was funded by the GCC and the Gulf. But many of these projects have now been completed, and you're seeing investment activity much weaker. Yes, tourism is still doing well. There's still a lot of tourist activity coming in from places like Saudi Arabia and other places. But again, the investment side, that has been much weaker. There have been some signs now. For example, just this week or last week, there was an announcement of a joint investment in a solar project that will supply Saudi. Will be in Saudi, but will support Bahrain. We've seen some progress on things like the refining, and refining output should benefit next year with the upgrades to the Citra refinery, etc. But I think it's very hard when you don't have the strong economic momentum to do much of these reforms. And I think still the need, there's still the need to cut back on operating expenditure on the budget as well.
Yeah, I mean, Bahrain, clearly fiscal story is there for in terms of stronger fiscal framework, looking at it on a medium-term fiscal perspective and trying to see what actions can be taken. There's a lot more room that can be done on both the revenue front. Yes, it's not easy, but they have to adjust. And on the spending side, including on operate, and I think the authorities are aware of that. I know there was a team in the field not too long ago. I think they press release on that, the fiscal consolidation that is needed going forward to maintain sustainability. And at the same time, you cannot grow without pushing on structural reforms. It's actually, of the GCCs, Bahrain is one of the more diversified. And I think it's a question of now how to sustain that going forward and trying to get some of the investment from the other countries where they are all moving. And they're moving quite a lot. I mean, we talked about Oman. I mean, Oman was in a situation where they decided to move on the fiscal, on the structural reform, trying to simplify the business climate, and they're reaping the fruits through FDI. And I think Bahrain needs to do exactly the same and pursue that and going forward. And I think this is probably what's on the agenda of the policymakers now.
I have a question online from Dr. Nazar Hilal at Qatar University. He says the GCC has significant wealth, and the IMF report emphasizes the long-term resilience of their economies. Does this mean the GCC should maintain constant policy discipline and adherence, whether in good times or bad? And I'm going to interpret this as meaning in terms of the fiscal policy advice, which is something I wanted to ask as well. In terms, I think, the message of the report is that, most of the countries have enough fiscal space to maintain spending levels in a downside oil scenario, as long as it's not too long term. But I guess if you could just maybe elaborate a little bit more, Amine, in terms of if oil prices were to be significantly weaker than in your baseline, what you would see as being appropriate policy on the fiscal side across the different GCC countries.
I think this is why it's quite important to look at this with respect to a medium-term fiscal framework and where is it that you want to be. Obviously, we have an oil path today that's, I think, on our baseline. We have it going and staying by 2031 at around $67 a barrel. We're not good forecasters, so we just use futures. So at least we don't get blamed for the forecast. But under that forecast, we know that what matters on the fiscal stance is the non-oil primary. So the fiscal effort that these countries are doing. What we're saying is that if oil price is going down, at least on the near term for some of those countries, they can absorb the shock and not do some of the mistakes that were done in the past, which is oil price went down and then we stop all the projects and then growth collapses and you make the impact even worse. And you've seen that happen. So the idea is that if that happens, let's try to accommodate. Sometimes you're going to have the sovereign wealth fund that could play a counter-cyclical role and would play in by coming in and increasing or putting some spending in the economy to try to offset the impact of the shock. But longer term, when we're doing it, so we have medium term, let's say 2031, depending on how permanent the shock is. I think the shock that we have looked at on oil price, for example, is temporary. We do believe that there is a price floor at some point. If the oil price is too low, we do believe, because then production, shale oil and all of that becomes much more expensive, and it would be difficult for that oil to come back online, and therefore we expect supply and demand to keep some sort of price floor on oil. But even with that, what matters is what's going to happen to 2050, 2100. And this is where we come back to our permanent income hypothesis, which is let's try to have intergenerational equity and make sure that we can smooth consumption over the longer term in case there is no oil or revenues from oil are not there. And this is why you keep seeing in our report, and here I had also the presentation, the chart about PIH. We believe that for the UAE, they were close to what's needed in terms of the fiscal stance. But for a lot of the other countries, you need quite substantial fiscal adjustment. So what we are saying, even though they have buffers, which can help them accommodate the shock today, over the medium term, a lot of these countries may have to do an adjustment of about 15, 20% of GDP, could be 0.51% of GDP a year. Can they do it? Yes, they have a lot of room on the revenue side and on the spending side. So that's a bit some of the, and it could go 16% of GDP adjustment, 12% in the case of Saudi Arabia, depending on how far they are from what we consider the deficit that would be prevalent over the longer term.
Thank you.
If you want to maintain resources constantly.
Are there any questions down this side of the room? Yes, please.
Kyle Fitzgerald with the National. So as we sort of look into 2026, it seems that there's going to be a much more dovish Federal Reserve, and there could be a sudden depreciation in the dollar. How are you looking at these potential developments with respect to the region?
Yeah, we look at it. Look, in terms of the weaker dollar for the GCC, we have a lot of the invoice. A lot of the imports are invoiced in dollars. If we look at it in terms of the size of the economy, we are not seeing much of an impact at this stage. We don't expect much of an impact on non-oil growth from a weaker dollar.
Monica, anything to add on the impact of a weaker dollar?
Absolutely, and indeed, in line with what Amine said during his presentation, I think that the Gulf pegs are the right policy, and with earnings here largely in the US dollar and imports in dollar, I think that's positive. But for the non-oil sector, especially, we feel it in the UAE. A weaker dollar is supportive of competitiveness in the non-oil sectors linked to tourism, aviation, etc. So I think again. I think much of the weakness in the dollar has happened. We do expect some further weakening next year with interest rate cuts from the Fed, but I think again nothing that will really impact the outlook too much for the Gulf.
Thank you. So we've run 5 minutes over our allotted time, so I think I'll draw the discussion to a close there. And once again, I want to thank Amine and Monica for agreeing to participate in the panel. I think an excellent discussion. I just encourage you to go and read the IMF report. I think it's it's probably still the best source for a combined view of detail in the GCC region. Find it on imf.org. And thank you all for joining us, both those in person who fought the cold in Washington, DC here this morning, and those of you who joined online. Thank you very much.